One thing to watch for here is that one reason the network effect works so well is the nonlinearity of nodes versus connections. So if you have a web and you have the number of nodes in that web goes from 1 to 2 to 3 to 4, the number of connections increases exponentially. So that is something that makes it very hard to replicate a network once the network gains scale, something that Googlers should be pretty familiar with, I think. One thing you want to watch for, though, is radial versus interactive networks. So the interactive network is what I just described, the web, where each node interacts with the other. A radial network is less valuable. So this was a good lesson I learned at Morningstar when we looked at Western Union. So Western Union, sends a lot of, helps people send money from place to place. And they talk about, we have the most number of branches of any money transfer organization in the world, which is true. The problem is that no one is sending money from Bangladesh to Mexico City. They're sending money from Mexico City to Chicago, or from Mexico City to LA, or from Bangladesh to Chicago. We have a huge Bangladeshi community there. No one's sending money from Bangladesh to Mexico City or vice versa. So that route means nothing. So it's basically a series of channels, a series of spokes off different nodes that are easier for a competitor to pick off by underpricing service in that node. So radial networks are much, much less robust than interactive ones, we found. And then the final type of moat, cost advantages. This is kind of self-explanatory. But the thing is, there's a couple of differences here that you should look for when you're looking at companies. A process-based advantage is basically inventing a cheaper way to do something that is hard to replicate quickly. Southwest did this, Dell did this, Ryanair did this. Inditex, which owns the Zara brand you may be familiar with, great example that everyone, they had the clothes made in Sri Lanka, the clothes made in Bangladesh because it was really cheap. But of course, because of transport links, you have to basically make a fashion bet 6 months in advance. What Inditex figured out was that if they nearshore it, if they get the stuff made in North Africa, get the stuff made in Eastern Europe, they could have much faster response times, much faster responses to different fashion trends. Now you can copy that, right? You can copy that, but it works pretty well while you're doing it. And so process-based cost advantages tend to work well, but then they get copied eventually. Southwest no longer has the lowest cost per available seat mile. People saw what they did and copied it. Scale, by contrast, when you spread your fixed costs over a large base, that tends to be much, much more robust. So think about this big network of brown UPS vans going around a neighborhood. What's the additional cost of putting one more package on the UPS van? De minimis, right? And so your margin on that is very, very high. Very difficult to compete. Good example, DHL, which is a wonderfully run business, has a very dense network in Europe. They lost over $1 billion trying to compete with UPS and FedEx in the ground market in the US. Couldn't do it, simply because they couldn't scale up. There weren't as many yellow vans as there were brown vans and blue and white vans. Scale-based advantages, especially in distribution, are incredibly robust. And you can have a niche where you establish minimum efficient scale. There are some niches, some industries that can only profitably support 1 or 2 players. If another player comes in, spends the money to get in, returns come down so that nobody makes any money, so that new entrant never comes in the market. That can be, the businesses often can't grow very well because they're kind of trapped there, but they can be enormously profitable. So what about management? You notice I haven't said a word about management yet. There's a great quote from Warren Buffett that good jockeys will do well on good horses, but not on broken down nags. So this is a professional jockey on a goat. He is a very good manager. Sadly, he is on a bad vehicle called a goat. So if you enter this in a race, he's probably going to lose. By contrast, if you got me, and I don't even know how to ride a horse, as long as I don't fall off, I probably beat the goat. Because the horse is better suited for winning races than the goat. You're not going to get much milk out of it. The goat is better for that. But it's very well suited for winning races. So the key here is that you want to get a good horse. You want to look for good horses. It's not that the jockey is irrelevant. It's that even the best jockey, if he's on a goat, isn't going to make you a lot of money or win many races. Managers matter in the context of the moat. And the way to think about this is very simple. The required level of managerial skill is inversely related to the quality of the business. The worse the business, the better the manager. The better the business, as long as management isn't that stupid, you'll do fine. If it's a really bad business, you better have an awesome manager. This is Ryanair. O'Leary is an absolute genius. He's a jerk, and customers hate flying Ryanair, but he has created an amazing, amazing business. Ryanair is scale advantages to die for. By contrast, if you have a great business, genius is not needed. You saw where this was going, I know. He's actually, what that actually means is, here's what's happened to Microsoft's moat while I've been in charge. It's an easy target here at Google, but it's true. I mean, Steve Ballmer essentially spent 12 years setting money on fire at Microsoft, as far as I can tell.
What do you think about Twitter?
Well, Twitter, never followed it much. And also that wasn't, no pun intended. The question was, what about Twitter? I haven't figured out what the monetization model is. I haven't figured out how they make money. I mean, they may have some secret theory. I just don't know what it is. But I haven't spent much time on it. Although I think it was founded by a guy named Dorsey, wasn't it? Mm-hmm. Anyway, I probably should look at it. So the key here is that moats can buffer management mistakes. Microsoft minted money despite Steve Ballmer. Despite them shoveling dirt in the moat every day, the core Office, the core Windows franchises were strong enough that the business overall maintained pretty high returns on capital. New Coke didn't kill Coca-Cola because the business was robust enough, the brand is strong enough. Moody's put profits before integrity, actively screwed investors, and still cranked out a 40% operating margin. That's a pretty good moat. But even a genius like David Neeleman couldn't change the fact that JetBlue is an airline, which is the worst industry known to mankind. I mean, he's an amazing manager. If you've ever met him, read any of his books, seen him speak, he's incredible, he's inspirational. You know, JetBlue was like 30-odd times earnings when it went public because it had leather seats and TV. I mean, an airline will never have lower costs than the day it opens for business. Why? Planes don't get newer, they get older. Employees don't get less seniority, they get more. So the planes cost more to run, the employees want more money. So the cost structure is inevitably bound to decline. Again, great jockey on a goat.